Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money.
Welcome back to the Investor Coaching Show. I'm Evan Barnard, and we're going to be talking about kind of some investment fads. I'd pulled up a list this morning. Some of these I'd forgotten about. And I want to go through these. Those of you that are investors and have been around investing or paying attention to that since the 70s, 80s, 1980 is when I graduated from high school. I was probably paying attention to investing a little bit before that, but not much. I grew up reading Forbes and Fortune in my dad's office. So I was paying attention to it, but was not any kind of investment, guru or anything like that at 16. But younger investors listening, you may not recognize some of these, so it'd be kind of fun to Google these over the rest of the weekend and read a little bit more of the history. And I'd asked for a list of investing fads that also included fraud. So not just legitimate investments that, were kind of hot stock kind of things, but, any fraudulent stuff that caught on. So I'll start with the late 1960s and early 70s, the Nifty 50. If you might remember that, it was basically a loose set of about 50, dominant U.S. growth companies. And kind of the argument was buy these no matter what the price was. Like these 50 stocks, this Nifty 50, they're gonna be the cat's meow as far as that goes. And, once there was a short-term track record to create that list, what happened? Institutional money piled in. This is kind of the early days for mutual funds. And so you had some, mutual funds doing Nifty 50 and all that. And, of course, valuations went all kinds of places, a lot of volatility. But what happened towards the end of that fad? It had severe underperformance after the 1973-74 bear market. And some of those stocks recovered later on, but, by then the fad had ended and the damage was done. And so, you may have this track record that says, hey, this is really great, and then you pile in right before it crashes. 1978 to 1980, the gold rush. What was going on? We had inflation. This is before Reagan had taken office. Excuse me. And, inflation, geopolitical shocks, dollar weakness. And so all of a sudden, people started investing in bullion. And gold ran from $217 an ounce in 1978 to $850 in 1980. And so that's what, about a 400% run in 2 years. And, we always have that story has been repeated numerous times over the last 40 or 50 years. Anytime there's political turmoil, we start hearing the ads for buy gold. And, we've shared this on shows before, but it's always interesting to know that if gold is my safe haven, why are they taking my dollars and selling me their gold? It just doesn't make sense. And the conclusion of that, there was a multi-year drop in price through the 80s and 90s. The Hunt brothers, 1979 and 1980, were trying to corner the market in silver, and they amassed just huge positions in silver. Silver went up to like $50 an ounce, and people were buying it because it was going to go to the moon. And, of course, it dropped back down, and for years it was back down to like $4 or $5 an ounce. And March 27th of 1980 was when that crash happened. And there were some legal implications as well. And, that's something that you have to be aware of is, okay, something may even seem like a legitimate thing. It's not, it's not a Ponzi scheme, but there's maybe something under the surface going on that, if you don't know what's happening, you're going to get crushed in this deal. And again, here's the context. Is your purpose important enough to not engage in this kind of behavior and stick to your principles? Or even if you decide you want to stick to your principles, Does your advisor or the newsletter that you follow or the podcaster or the new term, the finfluencers, are they encouraging some unusual strategy just because it's cool? Mid-1990s, I'd forgotten about this one, Beanie Babies and all that kind of stuff, collectible toys. I wouldn't really call that a market thing, but it was certainly an investment fad for people. And, folks were buying up Beanie Babies and selling them. And I think that kind of came almost at the same time that we started to have more online retailing and things like that. Of course, you had the dot-com, crush running up 1997 to 2000, and then the crash over the next couple of years. 2012, getting more recent, 2014, the 3D printing stocks, all of a sudden everything was going to be 3D printing. And, that was 12 to 14, and then 2014 to 15, the tech kind of moved on and everybody moved on to some other new fad. My favorite, not as a strategy, but on this list, cannabis equities in 2017 to 2019, the pot stocks right before COVID and all that kind of stuff. And then, of course, we now have the initial coin offerings, Ethereum, all that kind of stuff. And so a lot of that was fraud. Some of it was just junk. Meme stocks in 2021, and that persists to the present. Why do I want to talk about this? Well, we've talked about ESG investing, and that was kind of a recent fad. And, a lot of firms, pounced onto this ESG, environmental, social, and governance. And so it's a better way to pick stocks because these are responsible companies or so forth. And there's nothing wrong with the company being responsible. That's not the point. But there's no academic information that says that. And you'll know over the last several years, we've just said this is a bunch of smoke and mirrors, and just diversify globally and rebalance as things go on. But here's an article from, this is actually from last month, from the Journal, Wall Street Journal, James McIntosh. There's more information than ever on ESG investing, but it isn't helping. If extra information adds nothing new, it is simply a costly distraction. Defenders of environmental, social, and governance investing have mostly given up their strongest claim, that of doing well by doing good, that you can beat the market while helping improve the world. A new study finds that even their weaker financial claims don't stand up to scrutiny. The fallback position for ESG people in the face of political and legislative challenges in the U.S. is typically that ESG should be considered in their stock picking as financially material information, just like the balance sheet. How much debt do they have and how much how responsible are they? That it can help make a portfolio more stable, and that anyway, it's better to have more information than less. BlackRock called this ESG integration, looking at all that stuff. But here's the interesting thing. Research by a French university spin-out Scientific Beta confirms the difficulty of actually processing that information. They constructed a portfolio to make optimal use of 15 years of ESG information. And remember, we said it takes 64 anyway, but that's all they had. Balancing risk and reward while maintaining diversification using standard tools. In many cases, the model would have taken the anti-ESG position, buying stocks such as tobacco producers, buying companies generating environmental controversies, and selling companies that spend a lot on employee training or have employee involvement in the community. And so, as these fads go, you realize that most of the time investors pile in on the upswing a little bit too late, and you may not even lose money, but it starts to drop and you get out and you kind of end up repeating this cycle of buying high, selling low, which is not a great way to grow your net worth. What's the point and the comparison? Charlie Kirk did not sway from his principles. He defended it. He had the conversations out there on campuses and various forums, but you knew where he stood on issues. Whether you agree or disagreed with him, you knew where he stood. And we hold ourselves out the same way from an investment philosophy. We haven't strayed from the academic research. We take advantage of any actual research that shows up to make improvements if they're to be had, increasing diversification, reducing fees, those kind of things. But we don't get sucked into some new fad and chase performance, pick individual stocks just because they're popular or they sound good on the golf course or the pickleball court or whatever. And those things are important. You want to know that your strategy is going to be lasting throughout retirement and not depending on having to change to the next new thing in time.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.